Great. Hi, everybody. I'm Alfred Johnson.
Hi, I'm Melissa Peterson.
Should we do some quick intros and then go into the conversation?
Sure, go ahead.
Okay, great. So I'm Alfred. I'm the CEO of Crux Climate. We started right around the same time that it became legal to transact transferable tax credits. My background is in the Treasury Department, financial markets, and software. So started at Treasury working on the Financial Crisis Response and Recovery Act. Got to know the ITC and PTC in the context of that Recovery Act work. Worked in the White House, worked in structured finance at BlackRock, and then got into tech. So built and sold a marketplace software company once before, went back to Treasury, working for Secretary Yellen as her deputy chief of staff, was doing the COVID response, so trying to get $1 trillion out the door as rapidly as possible through the ARP, but also technology and financial markets work. Left in the summer of 22 before the IRA was passed and started looking at some of the innovation that was happening in the clean tech space, which was amazing and exciting. And Melissa has a lot more of the detail of the big things that companies like Orsted are doing. But one of my initial observations there was that was not a space that I had spent a lot of time thinking. But then the IRA passed and includes hundreds of billions of dollars of tax credits now transferable for the first time. And that requires a market to form very, very rapidly in order to drive the level of capital that we need to into these projects. So the market has been developing really, really quickly. We have now raised 27 million of venture capital. The team is about 20. And really what we're trying to do is add efficiency, standardization, and convene the largest market around these credits. And we're really lucky to have Orsted as an investor in the company.
Great, thanks. I'm Melissa Peterson. I'm the head of onshore development and origination for Orsted. I've been in the industry about 15 years, so I've seen a lot of different PTC cliffs and PTC iterations and things like that. So really excited to be up here today talking about what came out of the IRA and how we can utilize some of the creative tax credit and financing strategies to help continue to push this industry forward. So always a fun topic, and thanks everyone for coming.
Great. So we've organized the conversation around 5 key questions. And the first one is, what are some of the most significant changes in tax equity market in the last 12 months? What comes to mind for you?
Yeah, I mean, I think there's a couple ones. The first one, of course, is just the use of transferability and the direct pay in the IRA. I mean, previously, if you wanted to monetize a PTC or even an ITC, you really had to have a tax equity investor. And so just by adding those provisions in to the tax credits, it's really opened up the marketplace in terms of who can participate and who can play in that space. The second one is just the variety of new tax credits that we've seen, right? We've seen the advanced manufacturing is a great one. 45V, which is the green hydrogen tax credit. We're still waiting for some guidance there, but that's really helping to spur the industry forward. That's a $3 tax credit. That's making a huge difference for that industry, both in the US, but frankly, globally. It's one of the most lucrative tax credits to push green hydrogen in the world. And then the third in that space is the carbon credit sequestration, which is the 45Q, which is also a really interesting tax credit and hopefully will help really grow that carbon sequestration space a little bit more. And I guess the third thing that's really unique about the IRA and has really advanced the tax equity market, I would add, is just some of the bonus adders we have. So things like the prevailing wage, the energy communities, which is helping to grow not just the tax equity market, but actually put projects in areas that we need to have more in economic development. And then the domestic content, of course, creating more products here within our borders.
So I agree with all of that. An interesting complication of using tax credits as a mechanism of subsidy is, as you guys know, many of the developers that build this stuff don't have enough tax liability to use it, which led to the formation of this market, the tax equity market. That's a $20 billion market as of 2022. It's a $23 billion market in this last year in 2023. But it's ultimately an inefficient market in many ways. It's hard to pull these deals together. They're 1,000-page agreements. You need a lot of internal capabilities to do it. And there are a handful of providers that have historically been big investors in the space, which are basically the largest banks. So if you look at the top 10 providers of tax equity in that $23 billion market, they represent something like 85% of the market. And now the IRA supercharged the use of credits, right? Credits are the predominant mechanism of subsidy within the IRA. It increases credits, if you think about that as the supply side of the market, by 5 to 10x over the 10-year window. But Congress needed to solve this problem of monetization. And the tax equity market as previously constituted wasn't able to take that level of supply and process it. So transferability becomes this really important new mechanism. The only thing I'd add on top of what Melissa said there is when transferability was first passed, there was an assumption that tax equity and transferability would be mutually exclusive to one another. And now I think we are increasingly seeing the blending of the structures where tax equity can be put in place and credits can be sold from structures. And we'll talk a little bit more about some of the evolutions that we're seeing there. Guidance. So Treasury released guidance last week. What were your thoughts on it?
I mean, we were generally happy with it, right? I think it was very much in line with what we expected to see, and it was similar to the draft guidance that came out. Always appreciate any clarity, right? The worst place to sit is in a place of uncertainty. And so having that clarity has been incredibly helpful. It also really cemented transferability as an option. I know Alfred talked a little bit about it, but from a project owner standpoint, this tool will really unlock a lot of projects that maybe not have been able to get unlocked before, because beyond offtake, beyond permitting, beyond siting, tax credits and tax equity is one of the huge barriers to getting projects done. And especially in areas where the traditional tax equity partners may be a little bit long and don't want to do projects, it really helps move projects forward that might have been pushed up into this area that would have been hard to unlock. So I think it's incredibly critical for unlocking more green electrons than we'd ever seen before. And then, of course, it opens up the opportunity for lots and lots of corporates to get involved. I think we're still on the very front end of that. Crux is, of course, helping with that platform, but just, helping to work with that and having just a lot more pool of buyers who can help monetize and capture the value and help push the green economy forward.
Totally agree with all of that. So it became legal to transact the credits as of January 1st of last year. Practically nothing happened between January 1st and when the preliminary guidance came out in June of last year. And then things started to really accelerate through the late summer and fall. And I think that is demonstrative of the fact that the initial guidance was pretty strong and it allowed the market to form. So we did a market survey where we covered $3.5 billion of specific transactions that was using Crux data, survey data, and deals that were announced publicly in the market. And we used that 3.5 billion to extrapolate that 7 to 9 billion of transfers happened on 2023 credits. And I think if you think about the scale and the speed with which we got to a number that was that big, in a lot of ways, I think that's demonstrative of the fact that the guidance was already supportive of the market. So even though the final guidance was not materially changed, they didn't address some of the big issues that commenters had wanted them to change, I think it still supports the market forming in the way that they hope, and we hope that it will. Should we get into structures?
Structure is a good topic.
You want to start?
Sure. I mean, I think, again, I said this before, we're at the very beginning of this, right? So there's structures we don't even know about yet that haven't emerged. What we have started to see, and if you think about tax equity on a spectrum, right, on one hand, we have kind of the partnership flip, the classic, in a lot of ways as a developer, your hands are a little bit tied. The tax equity sort of owns the deal, all the way to the other end of the spectrum, which is more of like just selling PTCs on the open market, which is also hugely challenging. We started to see more of what we're calling like a hybrid structure. So sort of somewhere in the middle of that. So you're reducing risk on one hand, because the big banks are also helping facilitate. Those with a lot of the expertise in the space are still involved, but they're tapping into their networks to help pull more non-traditional tax equity people into this space, whether that's corporates or other people that have that tax equity appetite that don't know how to touch it. So, again, we've done quite a lot in 23. We're at the very beginning of this. We'll start to see more structures, but what we're starting to just see overall in terms of structuring is a lot more creativity and flexibility. The other thing we're starting to see a little bit is the traditional corporates that want to just do PPAs to meet their sustainability goals. We're having a lot of conversations around, you could also be part of tax credit transfers, or you could also look at how can you then use those tax credit transfers to help claim your sustainability targets, right? Because I think there's a little bit of a misunderstanding sometimes in the corporates that actually participating in tax equity is as meaningful, if not more meaningful, than doing the PPA, because that oftentimes is one of the big barriers to getting projects done. It's not always the offtake. And so we're starting to have a lot more of those fruitful conversations and a lot more players. And it's not just the big tech. I mean, I know immediately we think of the Microsofts, the Googles, the Amazons. Of course, they have huge tax base. And truthfully, they've talked about this for a long time. Google used to do tax equity deals. We're starting to see, I would say, like not second tier companies, but sort of second tier in terms of their understanding and their knowledge base on this, starting to ask more questions. So I think that's really, really exciting. So just the overall number of players is coming up that have an interest in this. And I think that's really a great space for us to be in. And a lot of collaboration we're seeing that we maybe haven't seen before.
Totally agree. And I think fundamentally, it's interesting to think about what tax equity does, right? They're like three material things that tax equity does. And this is a dramatic oversimplification, but it allows the developer to step up the basis, it monetizes the credits, and it monetizes the depreciation. And if you think about it, those three things are still things that developers want in a transferability world. They may want them in different composites based on what they're developing and what the underlying dynamics of that deal are, but they still need to be solved. And so, especially for the largest developers that still have access to tax equity, the banks still want to write tax equity checks into projects. Tax equity is being used to step up the basis in times that is appropriate to do. It's being used to monetize the depreciation. And then the bank or whomever is arranging the tax equity is using the transfer of the credits to pull in people into the structure that wouldn't otherwise have participated in the partnership. And I think to your point on that opening the door to more participation, there are just so many corporates that are out there that have said no to tax equity in the past. But when they look at the transfer, it's just a fundamentally simpler transaction. It's not simple, but it's a lot simpler. And that is drawing in a lot of participants from places outside of financial services, from family offices, from smaller companies. And we really need that given the extent to which the market is going to grow. Okay, what is required for the tax equity and tax credit market to accelerate even further?
Yeah, that's a good question. I think there's a couple things. One is education. This is a new space for many people. And when you look at people like big corporates, typically their sustainability group that's working on their PPAs or trying to figure out how do we meet our sustainability targets, and their tax group don't sit in the same spot. They don't have the same mandates and they don't have the same goals. So part of it is just education for everybody involved in that space. Second, in a lot of ways, I'd say sort of transparency and clarity on the market. Platforms like Crux, they're able to do that. They can provide access to that transparency and that clarity and that process really quickly. And then the third thing is something that is sort of on our plate in a way as a developer. It's just continuing to provide really high quality assets, right? That meet the investment thesis. We need to be putting out projects that are going to hit the returns that we say, that continue to be delivered on time, that continue to meet that requirement that we've committed to. And I think the more we do those, especially in the beginning, it'll give the confidence to the market that this is a place that they can play. The new entrants in the tax equity market, they're risk adverse. They don't know yet what if they should trust this, what this looks like. What if I invest in this and it doesn't come through? Then I'm in this position where suddenly I expected to be able to have these tax credits, and now I have this taxable liability that I need to pay, right? And so the developer community, the owners, operators, we need to make sure that we're upholding our end, which is really delivering super high quality assets that meet that investment thesis so that they can build that trust and confidence that these projects are reliable and will deliver. When they look at buying a tax credit for 3, 4, 5 years from now, it'll still be there.
I love that you focused on both the supply and demand side of that. I think a lot of times people look at the supply in aggregates, where we look at reports that come out from people like Evercore, who produce the most recent estimates on how big the tax credit market will be in 2024. And that shows the market on monetization getting to something like $40 billion of total tax finance that's needed this year. And if you think about what component of that will be tax equity and transferability, we think it'll be roughly half-half. And what that means is the transfer market grows to something like $15 or $20 billion this year. But it's also important, to your point, Melissa, that the credits be high quality credits, that buyers have a good experience buying, that the downstream implications of that and risk associated is manageable, so that demand is consistent over time. And I think if we've got high quality supply in the sizes that we're talking about, that allows us to bring in a lot more demand to the market. And again, we're going to need to go from 10 to 20 reliable providers of tax equity to thousands of investors in these credits to get to the accommodation of something like $80 or $100 billion worth of supply that's going to hit the market by the back half of the decade. What do you expect going forward? And what do you expect to see in 2024?
Yeah, that's a good question. I mean, of course, we sort of touched on this big topic of more buyers in the market. But I think we'll also see a lot more of some of these additional new credits that I mentioned at the very beginning, right? We're starting to get guidance on the 45V, which is the green hydrogen tax credit. You know, we're pretty close, hopefully, on that guidance. We'll start to see some of those monetized in the next couple of years and the momentum in the industry picking up there. Same with advanced manufacturing and the carbon sequestration credit. The other thing I think we'll see broadly in the industry because of all these bonus adders in the tax credit, we're going to continue to see more economic development in communities and in places that need that economic development. It's really exciting to think about, you know, not only are we growing the opportunity for the corporates, we're actually building opportunities in economic development and job creation for lots of parts of the US that need to have that influx right now. So it's really in a lot of ways a win-win. And I think, you know, as all of these clarity on these guidance and the Treasury is coming out with things and we're seeing projects go through it and the first movers are getting some wins, we'll start to see that momentum continue to pick up in 24 and 25 and 26.
I want to pick up on the point about the 3 categories of credits that are alternatively eligible for transferability and direct pay. Those 3 categories are 45X, advanced manufacturing, 45V, hydrogen, and 45Q, carbon capture. It's interesting, in the debate around Build Back Better, there was a lot of pressure from the industry that everything be direct pay. And the initial versions of Build Back Better had materially more of the credits be direct pay. And the government decided, Congress decided to make many of them, most of the corporate credits, transferable, but reserved elected pay for a 5-year period for those 3 categories of credits. A really interesting thing is happening in the market right now around those credits, where pricing is so solid on things like 45X credits, which have come to the market in reasonable size in 23 and 24, that those developers, manufacturers, are often electing to go to the transfer market as opposed to wait for elective pay. And the reason for that is that it's a time value of money consideration, where if you can get money now, even at a haircut, so money at 96 cents on the dollar, 97 cents on the dollar, whatever it may be, versus wait for payment from the government when your tax return is filed and the IRS processes it. At current pricing, a lot of 45X manufacturers and others are making the determination that that makes more economic sense. And so I think that is a reason why you're seeing so much growth in the transfer market of these new categories that were not historically monetized through tax equity.
Agreed. Any closing comments, Alfred?
So thank you all for coming. This was a good turnout for tax finance. One last thing I will point out, on Thursday of last week, Crux announced a partnership with ACP. They've been a great partner for us for a very long time, but we've made Crux available at lower costs to anybody who is signing up through that ACP partnership. We're really excited to both do that with them and then also produce a lot more content on the industry, in part because of your observation, Melissa, that we just need as much content and transparency on what's happening in this very new market as we can get. So thank you all for coming.